Hi, Bob Jennings here, talking with you today about 401k plans. You know, a 401k is an employer-sponsored retirement account. The money that goes into the account comes from two sources. It's primarily your money that you may defer on a tax-free basis, plus your employer is allowed to put money in for you. Let's talk about your deferral for the year 2009. How much can you put in? How does it have to go in? What about the earnings? What about the withdrawals? Well, the IRS sets certain limits, and your employer has their own limits as well, and every employer is a little bit different. But no employer may exceed the IRS limits, so what are they? For the year 2009, you may defer up to $49,000 into your 401k. If you're over age 49, under a special provision I like to call the geezer-pleaser provision, you can even put in an additional $5,500 if you're over age 49 on December 31st of the year 2009. All right, so you may defer up to $49,000. Well, what if you don't want to put that much in? Fine. There's no requirement for you to participate in most situations. You're allowed to defer nothing, all of it, or anywhere in between, because the IRS's limit is simple. You may defer the lesser of 100% of your income or $49,000. If you make $30,000, in theory, you could defer the full $30,000 if your employer allows it. All right, so the amount you defer, limited to the lesser of what you make, are $49,000. Now, how do you defer it? You know, you can defer based on a flat percentage every pay period. And by the way, you can change that anytime you want within your employer's parameters. Or, instead of using a flat percentage, you may defer a flat dollar amount every pay period. Or, you may do a lump sum deferral. Or, if you get a bonus, you may choose to defer the entire amount of the bonus. In other words, you as an employee get complete and total flexibility on the amount you defer. Now let's talk about the income tax effects when you defer money into a 401k. There are three main taxes we have to be concerned with. Let's assume that you make $50,000 this year and you decide to defer $5,000 into your 401k. Well, if you make $50,000 and you defer $5,000 into your 401k, that's only going to leave you $45,000. And that's what you pay tax on for federal tax purposes, is $45,000. Similarly, in most states, that's also the same number that you'll pay tax on for state income tax purposes. However, you will pay tax on the full $50,000 for Social Security. Now, you don't have to worry about it. You don't write a check for that amount. Your employer will just go ahead and withhold that little bit extra amount for you. But the entire $50,000 is subject to Social Security and Medicare, but you only pay income tax for federal and state purposes on the amount after deferral of $45,000. Now, once the money is deferred, what happens? Well, you are allowed to invest that money in whatever choices your employer gives you. The 401k itself, as established by your employer, determines where your investment options are. Wherever you invest it, whether it's stocks, bonds, mutual funds, CDs, whatever, the income that you earn in that account is free of tax while it stays in the account. Finally, what about when I take money out? I know I don't pay tax when I put it in. I don't pay tax while it's there. What about when I take money out? Well, there are 2 or 3 things to consider. First, if I am above retirement age, 59 and a half, I will pay income tax on anything I withdraw. Second, if I am not yet 59 and a half and I take money out, I will still pay income tax, but in most situations I will also pay a 10% early withdrawal penalty. In other words, we really don't want to see you taking money out of a 401k before age 59 and a half because of that 10% penalty. Now, there is an exception to that rule. Most plans allow you to borrow from your 401k up to $50,000 maximum borrowing. Now, you have to pay that money back. You have to pay it back over no more than 5 years, and you have to pay a reasonable rate of interest. But, you know, you're basically paying yourself when you do that. All right, so from the employee's point of view, you may defer the lesser of 100% of your income, or $49,000, plus $5,500 if you're over age 49. Secondly, you may defer the amount based on a percentage, a flat dollar amount per pay period, a lump sum, a one-time payment. You get total flexibility. Third, the earnings in that account, as we said, are tax-free or tax-deferred. And fourth, any withdrawals from the account you're going to pay tax on, And if you're under 59 and a half, you'll also pay a penalty on it for early withdrawal. There are a couple of exceptions to that rule that your tax professional can tell you about. And the only other exception is you are allowed to borrow from the account. Now, what about the employer side? We said at the beginning, the money that comes into the 401k comes from two sources. Partially yours, the employee, partially your employer. Well, your employer, the plan itself defines how much they have to put in. Some 401k plans require the employer to put in an equivalent amount to what you put in. Those plans generally are called safe harbor plans, and it says the employer has to match 100% of what you put in up to 3% of your W-2. But not all plans are like that. Some employer plans are voluntary contributions. That means the employer doesn't have to put anything in, but if they put money in, they have to put in an equal percentage for all people. Now, I can't tell you which kind of plan your employer has. You'd have to read the 401k document you have yourself, but there are essentially two types. The required employer match that many people have, or the voluntary employer amount that many people also have. There's an equal mix of these throughout America. Well, if you have further questions on the 401k, please contact us at the phone number or website at the bottom of your screen. Again, I'm Bob Jennings, thanking you for listening today to our 401k discussion.